Welcome back to the deep dive. This is where we dig into a complex pile of research and try to pull out the clearest, most useful insights for you. And okay, just a quick note before we jump in, we really run on your engagement. If you find this deep dive useful, please take a second to subscribe, maybe drop a comment, engage with the video. It genuinely helps us out, boosts us in the algorithm, and lets us keep making this kind of detailed crypto content. All right, today's topic, Bitcoin mining. It's like the engine room for the whole Bitcoin network, but honestly, it often feels wrapped up in really dense tech speak, fierce economic battles, and these huge debates about its environmental footprint. So our listener, the learner, sent over this massive stack of sources. Seriously, everything from like hyper-specific hardware efficiency stats to the stock charts of giant public mining companies. Our mission today is pretty clear. We need to figure out if that original Bitcoin gold rush, the idea that an average person could jump in and make a profit mining, if that's actually over, has mining basically become a game just for big institutions and arms race?
Or is there still a real opportunity somewhere in there? Okay, let's unpack this thing. Let's get to the bottom of it.
Yeah, and what's really fascinating, I think, is that most conversations about mining get stuck on the downsides, right? The cost, the energy use. But we absolutely have to start with why it's so critical, like fundamentally critical to Bitcoin's integrity, its structure. So we'll dig into the why mining is just non-negotiable for security. And then we'll get into the how the economics, the sheer requirements have radically changed the whole industry, especially in just the last few years.
Okay, and we're going to kick things off with a question pulled straight from our sources. It's provocative, and it really hits the core dilemma anyone thinking about this faces right now. It's this. If you had, say, $10,000 burning a hole in your pocket today, would you put that money into buying a specialized ASIC mining rig plus all the setup needed to run it, or would you just buy $10,000 worth of Bitcoin itself and hold on to it? We're going to use everything we uncover in this deep dive to try and answer that question, like really comprehensively. Okay, so for anyone out there who thinks mining is just, I don't know, a cute metaphor, let's really nail down the technical reality. What are miners actually doing, and why is it so vital for the whole Bitcoin system?
Right. At its absolute core, Bitcoin mining is really about two things: securing the blockchain and validating transactions. That's it. Miners use just enormous amounts of computing power. They're all competing to solve this really complex mathematical puzzle. And the first one to crack it gets the right to propose the next block, basically a bundle of verified transactions to add to the chain. When the network accepts that block, the miner who found it gets rewarded with newly created Bitcoin, that's the block reward, plus all the transaction fees from the transactions inside that block.
Got it. So they're not just like magically finding digital coins in the ether. They're actually doing the work of confirming every single transaction that happened since the last block. They are the decentralized verification system.
That's a perfect way to put it, yeah. The process itself is called proof of work, or POW. The work part is literally that computational effort, the energy spent solving the puzzle. And this effort is so crucial because it makes verifying transactions really, really expensive computationally, which in turn makes it incredibly costly and just plain difficult for any bad actor to get enough control, enough hash power, enough computing resources to rewrite the transaction history. The cost to attack the network is designed to be prohibitively high, precisely because of the cost and scale of all that mining effort.
Okay, so the cost is actually a feature here, not a bug. It's what guarantees the decentralization, right?
Exactly. That's the fundamental point. The miners are essential for maintaining that decentralization and the network security. Think of it like this. The more individual miners there are and the more computing hash power they collectively have pointed at the network, the harder it becomes for anyone to pull off what's called a 51% attack.
Where someone controls the majority of the network's computing power.
Yeah, precisely. If someone controlled over half, they could potentially start messing with transactions. So mining is really the engine driving the integrity of the entire system. Without, thousands of independent miners spread out geographically, all checking transactions based on the agreed upon rules, the network just wouldn't function as a trustless system anymore.
Which means if we want to gauge the network's security, its overall health, we should look straight at the hash rate.
That's the key metric. The health of the mining sector, which we measure by the total dedicated hash power securing the network, usually in exahashes per second, EHs that directly mirrors the health of Bitcoin itself. When you see that hash rate number consistently climbing, it's a strong signal. It means people are investing heavily in the infrastructure, they have confidence in Bitcoin's future value, and the network itself is becoming more robust, more resilient, more secure.
Makes sense.
Yeah, that's why analysts track hash rate almost religiously. It's a tangible, real-world number reflecting network security, and it's tied directly to big capital investment decisions.
Okay, this leads us right into the economics. We've established that securing the network takes immense computing power. Now we need to get specific about what that power looks like and, crucially, what it costs. Because, let's be honest, the days of mining Bitcoin on an old laptop or even a decent gaming PC are long, long gone.
Oh, absolutely, long gone. The barrier to entry today is all about specialized hardware. To mine Bitcoin's algorithm, it's called SHA-25V6 efficiently, you basically have to use an ASIC rig. That stands for Application-Specific Integrated Circuit. And this isn't just like a faster graphics card. It's a chip designed from the ground up for one single purpose: calculating SHA-256 hashes as fast as humanly possible and doing it using as little electricity as possible.
Can you maybe expand on that? Why is the ASIC advantage so huge? Why can't someone with, say, a whole room full of powerful GPUs compete effectively anymore?
Yeah, the difference is just astronomical. It's the fundamental reason why, that initial gold rush feeling is basically over for the average enthusiast miner. A really high-end gaming GPU might push out, tens or maybe hundreds of megahashes per second, right? MHs. And it uses a fair bit of power doing it. A modern ASIC miner, it operates in the terahash or even petahash range. That's trillions or quadrillions of calculations per second.
Wow.
Yeah. And critically, it does this with an exponentially better efficiency, more computations for every watt of electricity burned. So GPUs just can't compete. It's impossible. The hobbyists using general hardware stand zero chance against a machine purpose-built to do that one cryptographic calculation billions of times faster and way more efficiently. And the big institutional players, they know this. They use their access to capital to make sure they have fleets of the latest, most powerful ASICs.
Okay, so step one is the high upfront costs for these specialized ASIC rigs. But we also know that's not even the biggest hurdle. It's the recurring cost, isn't it?
100%. The biggest ongoing expense, the real make-or-break factor for every single miner, is electricity. Power cost is the primary, absolutely dominant factor determining if you make money or lose money. These machines, these stacks of servers, they run flat out 247, 365 days a year. Even tiny differences in your electricity price, your cost per kilowatt hour, can swing you from being profitable to being instantly bankrupt. And that's why geography is so incredibly important. Miners are constantly hunting for what's called stranded energy assets, or regions that just have exceptionally cheap, reliable power deals.
Right, so if you're sitting in, say, California paying 20 cents per kilowatt hour, you're playing a totally different game than a big mining company that's set up next to a hydroelectric dam in Washington State and it's paying maybe 3 cents.
That's the perfect example. Miners live and die by what's called the break-even electricity cost calculation. They plug in their specific rig's efficiency, usually measured in joules per terahash, the current network difficulty, and the spot price of Bitcoin. And that tells them the absolute maximum electricity price they can pay per kilowatt hour and still, break even or make a tiny profit. So like you said, if Bitcoin's at $60,000, that miner paying 3 cents KOI is doing great, highly profitable. But the exact same miner with the exact same hardware in that high-cost area paying, say, 15 or 20 cents, they're bleeding money every second, even if Bitcoin stays steady at $60. This intense sensitivity to electricity cost forces operations to cluster around the cheapest power sources they can find.
And just to make things even more challenging, the Bitcoin system itself is designed to automatically shrink their main source of revenue over time. Let's talk about the halving.
Ah, yes, the halvings. They're Bitcoin's built-in scarcity engine, essentially. They act like this economic pressure cooker on the miners. Roughly every 4 years, technically, every 210,000 blocks mine the block reward. That amount of new BTC miners get for finding a block gets cut exactly in half, automatically. We've already seen this happen several times, 2012, 2016, 2020, and the most recent one was just in 2024.
Let's break down what happens right after a halving. What's the immediate effect on the miners?
The immediate impact is brutal. It's a sudden, drastic cut in their revenue. Take the 2020 halving, for example. The reward dropped from 12.5 Bitcoin per block down to 6.25 Bitcoin. So overnight, your gross income is slashed by 50%. But your costs, your electricity bill, your hardware payments, your facility rent, your staff, they all stay exactly the same.
Ouch.
Yeah. This forces what the industry calls a shakeout. The less efficient miners, maybe those running older, less power-efficient ASICs, or those stuck with higher electricity contracts, they often have to shut down almost immediately. Their operational costs suddenly exceed their halved income.
So the halving acts like a filter, clearing out the weaker, less efficient operations, which kind of reinforces that trend towards bigger, more efficient institutional players.
Exactly right. It forces consolidation and efficiency. The only thing that really saves the remaining miners after a halving is if the market price of Bitcoin itself goes up significantly to compensate for that smaller reward. And historically, we have often seen Bitcoin's price appreciate quite a bit in the, say, 12 to 18 months following a halving event. That rise eventually restores profitability for the survivors, the ones who manage to stay efficient. So the halving cycles really act as this self-regulating mechanism. They basically mandate constant improvement, ever-increasing efficiency, and newer technology just to survive the cut. And all of this brings us squarely to what we're calling the Great Shift. You know, when we talk about whether mining is viable, it's really not about an individual's tech skills anymore. It's about institutional scale and, crucially, access to capital. The whole landscape has shifted dramatically away from that image of the hobbyist in their garage.
I want to hone in on the scale difference here. Just how big is the gap between a small independent miner and these huge institutional players you mentioned?
Oh, the difference is staggering. It really comes down to access to capital markets. A small-scale retail miner is funding their operation, their capital expenditures, their CapEx, probably from their own savings, right? Now, contrast that with the big institutional players. We're talking about publicly traded mining companies. Think Marathon Digital Holdings, that's MARA on the stock exchange Riot platforms, ticker RIOT, Hut8. The key thing here is that these are public companies. They can raise enormous amounts of money by issuing stock, taking on debt, getting lines of credit. This ability to tap capital markets is the ultimate wall that retail miners just can't climb over. I mean, Marathon and Riot, just those two, collectively control hash power measured in the tens of exahashes per second. That's computational power dwarfing the capacity of many entire countries.
And that massive pool of capital lets them do things like constantly buy the newest, most efficient ASIC models in bulk, securing discounts, and negotiate these incredibly favorable long-term power contracts. It creates this sort of perpetual dominance cycle.
It absolutely does. They're just playing a totally different game. The average person simply cannot get their hands on, say, the latest generation S21 ASIC rigs at the scale needed or at the price point institutions get.
Okay, so if the average person realistically can't afford to build and run their own large-scale mining farm, what are the main ways someone today might still get some exposure to the mining side of the Bitcoin economy without that massive personal outlay?
Yeah, the sources point to two main legitimate routes for the average investor who wants maybe some fractional exposure without the huge operational burden. The first is using hosting services. This is where you actually buy the physical mining machine, but you pay a specialized company to install it, run it, and maintain it within their large, efficient facility. This takes away the headache of dealing with the heat, the noise, the setup, the electricity contracts.
Okay, so you own the hardware, but someone else manages it.
Exactly. The second option, which is probably more common and maybe simpler, is joining a mining pool. Here, you contribute whatever hash power you do have, maybe from one or two machines you run yourself, or have hosted into a large collective pool with thousands of other miners globally. When the pool collectively manages to solve a block, the Bitcoin reward is then distributed amongst all the pool participants, proportional to how much hash power each person contributed. It smooths out the randomness of finding a block.
We really need to stress the warning here, right? Specifically about cloud mining scams versus legitimate services.
Oh, absolutely vital. There's a massive difference between legitimate hosting, where you provably own specific physical hardware, and these things often marketed as cloud mining. Cloud mining operations often promise fixed returns if you just rent hash power from them, usually without you ever seeing or verifying any actual underlying hardware exists.
Sounds fishy.
It often is. Many of these turn out to be unsustainable Ponzi schemes or just outright frauds, taking money for non-existent mining capacity. The golden rule for anyone looking into this space is stick to platforms where you can verify everything, demand transparency, and ideally get proof that you actually own the physical machine generating the hash rate. Be incredibly skeptical of guaranteed returns. Now, beyond this shift towards institutions, the actual map of where mining happens globally has been completely redrawn, and it was largely due to one single political event, China's ban on Bitcoin mining back in 2021.
Right, that was a huge moment. One analyst in our sources called it the Great Hash Exodus. Can you talk about the immediate chaos that ban caused, both financially and operationally?
Yeah, it was seismic. For years, China had dominated global Bitcoin mining, controlling well over 60%, maybe even 70% at times, of the total network hash rate. So when the government announced a sudden, sweeping ban, it forced an immediate shutdown and relocation of literally billions of dollars worth of specialized mining equipment. The network saw this huge, though temporary, plunge in its total hash rate, which technically meant a temporary reduction in security. And countless mining companies faced massive financial hits trying to get their expensive, sensitive gear out of China and relocated somewhere else, often having to use expensive air freight just to move it quickly across continents. It was pure chaos, but that chaos also created this sudden, massive opportunity for other countries or regions that were willing to welcome these displaced miners.
And who ended up being the main beneficiaries? Where did all that hash power land after leaving China?
The biggest winner, by far, was the United States, especially states like Texas, which offered a combination of relatively cheap energy, a deregulated market, and generally a more welcoming regulatory stance at the time. Kazakhstan also became a major destination initially, leveraging its existing infrastructure for cheap natural gas and coal power. Although that came with its own set of political risks and infrastructure strains later on. And another really interesting destination that emerged was El Salvador.
Ah, yes, the volcano mining. Tell us a bit more about El Salvador's strategy there, particularly that government-backed geothermal project.
El Salvador's approach is fascinating because it directly links clean energy generation with a national economic strategy around Bitcoin. This volcano mining project aims to use the country's abundant geothermal energy resources, essentially, steam generated by volcanic activity underground, to power Bitcoin mining facilities. It serves as this really powerful example, a supporting story, showing how governments can potentially attract this very capital-intensive, security-focused industry by offering not just cheap power, but specifically state-backed, 100% renewable power. It tries to fundamentally change the narrative around mining's environmental impact, at least for that specific operation.
Okay, so all this movement, all this new investment, it obviously impacts how the network itself operates day to day. This brings us back to those key metrics for visualizing network health. We've talked a lot about hash rate, but we really need to focus on the other side of that coin, mining difficulty.
Right. Mining difficulty is sort of the silent killer, especially for smaller or less efficient miners. The Bitcoin network is programmed with a target. It wants a new block to be found, on average, roughly every 10 minutes. That's the goal. Mining difficulty is the network parameter that automatically adjusts itself. It recalculates about every 2 weeks or every 2016 blocks to make sure that 10-minute average block time is maintained, no matter how much total hash power is currently pointed at the network.
And what really struck me looking at the charts is how, as these huge institutional players pour billions into deploying more and more hash power, the difficulty just keeps marching relentlessly upwards. It basically guarantees that mining hardware becomes obsolete faster and faster.
That's the key dynamic, yes. When huge amounts of new, highly efficient hash power come online, say, from a big institutional miner firing up a new facility, the average time to find a block will temporarily dip below 10 minutes. The network protocol sees this, and at the next adjustment period, it automatically increases the difficulty. This makes the mathematical puzzle harder to solve, demanding exponentially more computational work, more hashes to find the next block. This continuous upward march of difficulty creates a perpetual hardware arms race. The moment you buy and plug in a brand new top-of-the-line ASIC rig, its profitability clock is already ticking down, because you know the difficulty is almost certain to keep increasing over its lifespan. This cycle puts an incredible squeeze on profitability, especially for anyone not running the absolute latest, most efficient gear. It forces miners to constantly reinvest in newer hardware just to try and maintain their existing share of the block rewards. It further disadvantages the little guy.
All right, we absolutely have to tackle the biggest and often the most controversial aspect of this whole deep dive, the environmental debate. We just can't talk about Bitcoin mining without looking really closely at its massive energy consumption. What are the core arguments here that we need to understand?
Yeah, you have to start by acknowledging the sheer scale. Critics often point to research, like data from the Cambridge Bitcoin Electricity Consumption Index, which estimates that the Bitcoin network's total energy usage can rival or even exceed that of entire countries like Argentina or the Netherlands. The central criticism is that this energy use is inherently wasteful, especially when it contributes to carbon emissions because the power is being generated from fossil fuels like coal or natural gas. Is this a necessary use of scarce energy resources? That's the core question they raise.
But the story gets more complicated, doesn't it? because that relentless drive for the absolute cheapest electricity, which we talked about being crucial for profitability, seems to be increasingly pushing miners towards energy sources that might otherwise go unused, including renewables.
Exactly. The intense economic pressure is, somewhat ironically, driving innovation in sustainable practices. Think about solar or wind farms. They often produce more electricity during off-peak times, like sunny afternoons or windy nights, than the grid actually needs right then. Often, this excess renewable power has to be curtailed, basically wasted, because there's no buyer for it at that moment. Bitcoin miners, being location agnostic and hungry for cheap power, can set up shop right near these renewable sources and act as a sort of buyer of last resort. They can soak up that surplus clean energy, providing revenue for the renewable generator and improving the overall economics and utilization of that green infrastructure. This is why we're seeing a significant growth trend in mining operations powered partly or wholly by renewables.
And one of the most compelling examples of this mitigation potential seems to be these flare gas initiatives. It really sounds like a potential win-win, turning waste into value while cutting pollution.
It genuinely is a powerful narrative and potentially a very positive solution. It addresses both waste and the miner's need for cheap energy simultaneously. Okay, so in oil and gas fields, especially in remote areas, natural gas comes up alongside the oil. If there's no pipeline nearby to economically transport that gas to market, companies often just burn it off right there at the wellhead. That's called flaring. Flaring releases methane and CO2, potent greenhouse gases, directly into the atmosphere. It's a huge waste and a significant environmental problem. Bitcoin miners, however, can bring mobile mining containers, basically data centers and shipping containers, right to these remote oil wells. They capture that waste gas before it's flared, run it through generators to create electricity on site, and use that electricity to power their ASIC miners.
So they monetize a waste product that was going to be burned anyway?
Exactly. They turn a polluting waste stream into revenue while significantly reducing the greenhouse gas emissions compared to just flaring the methane directly. It's a very strong argument for how mining can actually help mitigate an existing environmental problem in specific contexts.
Let's connect this to that Texas example you mentioned earlier. It seems to perfectly illustrate this dual role miners can play, sometimes straining the grid, but other times potentially helping to stabilize it.
Texas is really the prime case study for how mining interacts with a modern electricity grid. Its deregulated energy market and abundance of cheap power, including a lot of wind power, initially attracted a massive influx of mining operations, especially post-China ban. Now, during periods of extreme grid stress, like a major heat wave in summer or a severe cold snap in winter, yes, these huge mining farms definitely add to the demand load, consuming enormous amounts of electricity when supply is tight. However, they also offer something really valuable back to the grid operators: flexible load capacity. Mining is what's called an interruptible load. Operators can shut down their entire facility almost instantly, remotely, without damaging the equipment or losing much more than the opportunity cost of mining for those few hours.
So they can basically be paid to turn off when the grid needs power most.
Precisely. Grid operators can offer incentive programs, often paying miners quite well, to curtail their operations during these critical peak demand periods. When they power down, they instantly free up potentially hundreds of megawatts of electricity capacity that can then be used for essential services like hospitals and residential cooling or heating. They act like a giant, geographically distributed, fast-acting shock absorber for the grid.
That's fascinating. A potential grid stabilizer, not just a drain.
Yeah, it adds resilience. So looking ahead, the so what here is that these sustainability efforts, miners actively seeking renewables, utilizing waste energy like flare gas, participating in grid balancing programs combined with regulatory certainty, are likely going to shape the future geography of mining. Jurisdictions that can offer that magic combination: cheap power, predictable regulations, and ideally pathways towards greener energy sources, those are the places attracting the big institutional capital and winning this global hash rate competition.
Okay, let's bring this entire discussion right back around to our listener and back to that initial question. Given everything we've talked about, the dominance of institutions, the constantly rising difficulty, the huge capital needed up front, is it actually still worth it for an average individual investor to even try and get into Bitcoin mining today?
You know, at the end of the day, it really boils down to a pretty straightforward financial calculation: opportunity cost. Any potential retail miner needs to very carefully weigh the cost of putting their capital, let's use that $10,000 example again, into specialized hardware, these ASIC rigs, which we know depreciate relatively quickly and have ongoing running costs. They need to weigh that against the alternative of simply taking the same $10,000 and buying Bitcoin directly on an exchange and holding it. Choosing to mine introduces a whole host of operational risk and complexities that just holding the asset avoids. You've got potential hardware failures, ongoing maintenance, unpredictable swings in your local electricity price, and that ever-present risk of your expensive hardware becoming obsolete because the network difficulty keeps climbing.
It really sounds like, unless someone has a very specific, unusual advantage, maybe they already have access to genuinely free or near zero-cost electricity, like massive excess solar power from their own home setup. The sheer complexity and financial risk of mining just doesn't seem to stack up well against simply buying and holding Bitcoin directly anymore.
I think that's the financial reality for, probably 99% of average retail investors today. When you ask that question, would you rather mine Bitcoin or just buy and hold it? For most people, buying and holding, or huddling as the community calls it, just eliminates all that operational headache. It's extremely liquid, they can buy or sell small amounts easily, and you avoid the big upfront capex hit and the depreciation risk that comes with owning the physical mining hardware. Direct Bitcoin mining has overwhelmingly become a game for specialists. It's a low-margin, high-volume business run by professional operators with access to cheap power and capital, not really a viable passive investment strategy for the average person anymore.
Okay, but even if most of us aren't going to be firing up our own mining rigs, paying attention to what's happening in the mining industry itself, the metrics, the trends, it still seems really valuable as a kind of barometer for the overall health of the Bitcoin market, right? If we connect this to the bigger picture, how should someone who just holds Bitcoin use mining trends to maybe inform their perspective?
Oh, absolutely. Watching the mining sector is an indispensable tool for gauging Bitcoin's overall health and also gauging investor sentiment. As we established earlier, the network hash rate is probably the single best indicator of the network's fundamental security and resilience. Seeing that trend upwards is generally a positive sign. But beyond that, you can glean some really deep insights by watching the financial performance of those large publicly traded mining companies we talked about, Mara, Riot, Hut 8, others. It's often really useful to overlay their stock price charts directly onto a Bitcoin price chart.
Why are those particular stocks, the miner stocks, considered such a useful proxy for sentiment or market health?
It's because these mining companies are essentially leveraged plays on the price of Bitcoin itself. They have very high fixed costs, the facilities, the hardware financing, the baseline electricity contracts. Their profitability is extremely sensitive to the price of Bitcoin. When BTC price is low, they might be barely breaking even or even losing money. But when the price of BTC runs up significantly, their profits can explode upwards very quickly because their revenue skyrockets while their costs stay relatively fixed. So investor confidence in Bitcoin's future price often translates into buying these miner stocks. Investors anticipate that if Bitcoin goes up, these companies will generate massive profit growth, potentially outperforming Bitcoin itself during a bull run.
Okay, leverage.
Exactly. Conversely, if you see these miner stocks struggling badly, maybe underperforming Bitcoin significantly, or if you see them constantly having to issue new shares, diluting existing shareholders, just to raise capital to survive, that can be a warning sign. It often signals that the miners are facing extreme pressure on their profit margins, perhaps due to high electricity costs or falling BTC prices, suggesting stress in the fundamental economics of the network, or maybe just low confidence in the near-term price outlook. So yeah, keeping an eye on the financial health and stock performance of the big public miners gives you this kind of real-time window into the underlying profitability and sentiment surrounding the entire Bitcoin network.
That's a really valuable lens, even for those of us who just hold the coin directly. Okay, let's try to quickly synthesize the key takeaways from this deep dive then. Bitcoin mining, still absolutely critical, right? It provides the security, the integrity, the trustlessness that makes Bitcoin work. That hasn't changed. However, the economics, the how, has fundamentally transformed. It's really become an institutional arms race now. Success is defined by massive capital investment, bleeding-edge technological efficiency, and that relentless hunt for ultra-cheap, reliable power, increasingly renewable power, and for the average investor. The opportunity cost calculation seems pretty clear. The complexity and risk of direct mining generally doesn't stack up against simply buying and holding Bitcoin itself.
And building on that, it raises a really important, maybe even slightly uncomfortable final thought for reflection. We talked about how the global mining map got redrawn after the China ban, leading to a concentration of hash power, especially in North America, often in the hands of these large, publicly traded, and therefore highly regulated corporations. This growing concentration presents a fascinating trade-off, doesn't it? On one hand, you could argue the network is more professionally run and maybe even more secure in some ways because of this massive hash rate deployed by well-capitalized entities. But is that efficiency, that professionalization, worth the potential risk? Does concentrating so much mining power into the hands of large companies, companies accountable to shareholders and Western governments, start to pose a long-term threat to that core principle of decentralization that Bitcoin was originally founded on?
That really is the ultimate tension, isn't it? Efficiency versus the original principles. And that's a crucial question for you, our listener, to think about as you digest everything we've covered today. Thank you for digging into this complex world of Bitcoin mining with us. We will catch you on the next deep dive.